need to move to the RPM. So when we are going ahead with the RPM, we need to see the two things. First is how we compute the gross margins, and the second one is computation of ALP. I'll open the practical case file for which we need to compute the RPM, for which we need to arrive at arm's length price under the RPM method. Now guys, as you can see here that I have for first step is I need to compute the gross margins of the comparable companies, right? Now here I have assumed that in case if there are 4 comparable companies in scenario number 1, as you can see here under scenario number 1, I have assumed that there are 4 comparable companies whose financial data I am analyzing for computing the gross margins. As you can see, this is sales or revenue from operations. So here I have computed taxpayers gross margin, which is right now coming at 1%, that is sales less cost of goods sold and changes in inventory, and direct expenses I have not kept here right now. I'll explain why I have not kept here right now, but then after the gross profit comes at minus 100 and the gross profit on sales is 1%, right? Now we have assumed here that there is this purchase transaction which has happened between the taxpayer and its A. That is what the presumption is, and that is where we have taken the base of sales. We will be discussing the PLI, that is profit level indicator, wherein we will be discussing the base also, that what base we should take, right? When we compute the margins. Here I have for the sake of understanding, I have assumed here that there has been a purchase of goods by the taxpayer from its A's. Now the gross margin which has been earned by the taxpayer is 1%. Now we see the comparable scenario, what is happening right now here. Now under comparable company 1, we have all 3 years of data, that is current year, which is FY 22-23, then 21-22 and 20-21. We have current year's data. Then we have data. So this all data will be available from the audited financial statements which the company must have filed with the MCA authorities, right, with the Ministry of Corporate Affairs. They must have uploaded that, and from that this data we would have captured. Now there is a comparable company 1 which has sales during this 3 years, and as you can see we have captured cost of goods sold. Now why I have not captured direct expenses? Because as per the new format of profit and loss account, there is no bifurcation between direct and indirect expenses, and that is where it is difficult for us to identify direct expenses when we are using the RPM method. And that is where in general what we can take position is that we will not include direct expenses in either taxpayer also and either comparables also. So that is what we practically take the position. Why? Because we cannot identify the direct expenses from the limited amount of financial data which is available in the public domain, right? That is the financials which the company has reported with the Ministry of Corporate Affairs. We cannot find that type of data. If still you are able to find that data in all the comparable companies, it is good. Then because taxpayers data you will always have with you, but you won't have the comparable companies data with you, right? The internal data. That is internal in the sense the internal all the account heads and etc. From where you can identify that what are the direct expenses for that particular which has been incurred by the particular company while undertaking that transactions of sales, right? So that is where I have not included direct expenses. But if you see the methodology under the provisions, when we studied that, it included the direct expenses also. But in practical scenario we don't find that, so I have not included that part here in the taxpayer as also in the company. Now as you can see that there are 3 years available data for 3 years, that is current year and preceding 2 years prior to current year, right? So prior to 2 years prior to current year, so that data is available. So I have captured all the data and I have computed the gross margins, and I have also arrived at a weighted average gross margin. How I have arrived at a weighted average gross margin is basically I have first I have totaled out the gross profit of all 3 years, correct, and I have divided that by the total of sales which has been made by the company in 3 years. So this is how I have arrived at a weighted average gross margin for comparable company 1. Now we go to comparable company 2. Now under comparable company 2, right now the company has not filed. So presuming that I am right now in the month of August or September, the comparable company 2 has not filed the financials or the financials are not available on the public domain of comparable company 2, right? So I don't have to take any data of that company here. So once when this data will be available, and if your taxpayer is under scrutiny, then at that point of time you'll have to analyze this data also, because at that point of time this data could be available, right? That is what we read under that particular provisions, that you need to you need to consider that data once that is available on the public domain. But for current period it is not available, so it will be blank. Now the only 2 years data which is available is FY 21-22 and FY 2021, that is 2 years prior to the current year. That data I need to capture, and that accordingly I have computed the gross margin, and appropriately I have arrived at this weighted average gross margin for comparable company 2. Now in third case, what has happened here is that only 2 years data prior to 2 years data, that is of current year, and 1 year preceding the current year, that is available with me. I don't have this data for third year. So that is what the case is right now, that probably in this third year the company must have taken some extraordinary transaction, merger acquisitions would have happened, or probably the data has not been published on the is not available on the public domain only for the third. It may happen in certain cases that where in these 2 years your company could be comparable, and for this particular year the company was not comparable. Probably it has more related party transactions threshold, right? We will check that also, related party, once when we discuss the filters. But for the sake right now, for the sake of understanding, right now that comparable company doesn't have data in 2021. So what I will do is I will use this 2 years data, and appropriately I'll consider this data and arrive at a weighted average gross margins, right? Now then after there is comparable company 4, of which 22-23 data is available. However 21-22 the company is not the data is not comparable, or either it is not available, right? So we cannot go beyond then 2021. In case if the company is rejected in this year, we cannot go beyond. So the year is rejected in this particular part, then we cannot go beyond that. So that is why I have just made here a cross. So only for this year we need to take the arm's length, for this year only we need to compute the we need to consider the weighted average gross margin, right? So for my gross margin, weighted average gross margin will be not this sum, but it will be equal to this particular thing only, right? Because it doesn't have data, we cannot take the data even if that is available, because there is a missing 1 year, or probably 1 year under that year the particular company was not comparable. So I hope this entire computation of RPM is clear to you now. Now we move to the step 2, that is, first is we did the margin computation, that is gross margin computation, and that then after we come to the final data set, that is step 2 is I am drafting the final data set. Now if you see here, I have listed all the comparable companies, and then after I have jotted down here all the gross margins which are there for relevant year on year gross margins. And then after I have mentioned here the weighted average gross margins, and as the size of the data set is less than 6 comparables, so I need to average that, right? So I have here averaged that entire data set. I have come to an arithmetic mean technically, which is 12.81%. Now if you see how I compute the ALP in this scenario, now I have presumed here that during the year the taxpayer has purchased goods of around 6,000 rupees from its A, right? Now if you see the gross profit percentage of taxpayer, which is 1% in actual, right? And the arm's length margin is 12.81%. So there's a difference in GP percent of 13.81%, right? So that is where its profit needs to be increased to 13.81%. So technically this should be 13.81%. Right? Sorry, this should be 12.81%. And how it will be 12.81%? I need to add 13.81% margin to the transfer price, right? So I have to do that adjustment to the transfer price, so that the resulting thing here comes at 13.81%. So how will I do that? So sales amount is 10,000, correct? So now as we have computed this 12.81% on sales, right? It was gross margin on sales. So I need to, the sales of this company was 10,000. So appropriately the arm's length the arm's length price, or sorry, the arm's length gross margin of that company should have been 1380.93. Correct? So the arm's length margin of that company should have been 1380.93. So now what I will do here is that now I have to reduce this gross profit, right? As you must have seen under that RPM methodology, first you would have arrived at sale price, then you have to reduce that arm's length gross profit, right? And then after you arrive at a resulting figure from which you had to deduct your actual purchases. Now the differential part after that comes up to 1480, right, as per the methodology under that particular provisions. So that differential part comes to 1480. Now accordingly I will adjust my ALP so that my purchase is reduced by 1480 and I get the arm's length price. So this will be the adjustment amount. Now if I just draw up a revised profit loss account by considering this particular purchase, I should get 13.81% in the above computation. Let me just check that. So under this cost of goods sold, there would have been purchase of inventory. So I'll reduce 6000 from here and I will add back 4519.07. Am I getting 13.81? Yes. So this is the adjustment which I have to make under resale price method. I hope that clarifies. Now we will just move ahead to the second scenario. So similarly, as we saw in cup also, when there are more than 6 comparables, that is when you have more than 6 arm's length margins here, gross margins, then you have to first do the you have to arrange this entire thing as per the ascending order of the weighted average gross margin. So you have to change this entire order to the ascending order, and appropriately the value which lies at 35 percentile, that is, let me just number out also this thing. Just can I have, so this is serial number. Now S1 2 3 4 5 6, right? So if I just, first of all, what I will do is I'll arrange this entire data set which was raw before into an ascending order data set, and appropriately I will give them a serial number. Alright, so once I give them serial number, I'll come to know that at what value the arm's length price is lying, at particular value what type of arm's length price is lying, what amount of arm's length price is lying. So now again, to find that arm's length range, I have to determine the value at 35th percentile. Now accordingly I have to multiply 6 with 35% and I'll get the result as 2.1. So once I get this result 2.1, as it's a decimal number, so what I have to do is I have to convert that into a whole number, that is the value which is lying at the third place, which is 10.33%. So that is my starting price for arm's length range. My arm's length range will lie between 10.33% and the value which lies at 65th percentile. So 6 into 65% will be, which will be 3.9%. So then accordingly at fourth number of value, my this arm's length, whatever value lies at fourth number of line item, that will be the closing or the end arm's length range, end part of arm's length range. So my arm's length range would be 10.33%. My arm's length price or my arm's length gross margin should lie between 10.33% to 28.60%. Correct. Now as I know that my arm's length gross margin is not in the range, so I'll have to compute the median also, right? So now for computing median, now there is, if I do the 6 into 50%, then it gives me a whole number. So what the provision says that in case if there's a whole number here, then you have to average out the whole number and the next whole number, right? So the values which are lying at this at the place at third number and fourth number, I have to average it out. I'll just show you that. So if I have to average these values, and accordingly I'll get a median, the value which is lying at the median, right, which is 8.45. Now I will perform the same steps which I have performed here, and appropriately I will arrive at a arm's length price. Median is 8.45%. So in similar manner what we computed in the earlier scenario, the same way arm's length price will be computed. So that is presuming that 6,000 was the purchase value of that particular goods purchased by the taxpayer from its AE. then after the GP percent, that is 1% of the taxpayer, and then after the arm's length margin, which is 18.45%. Appropriately, we will follow that particular provisions, and appropriately we will arrive at a arm's length price which is 3954. That is, which is reduced from 6,000 to 3954. There will be an adjustment of 2,000 rupees in that arm's length price, and appropriately the purchase price will be reduced from the profit loss account, and the gross margins shall be recomputed and will come to 18.45%. I hope this clarifies. Now I meet you in the second video where we will be discussing the TNMM method and the aspects revolving around the TNMM method. I'll catch you in the second video. Hope you are enjoying this learning. Thank you.